Market volatility and tariffs are dominating the headlines, not just financial headlines, but global headlines. So let's talk about it. Joe Conroy, financial advisor with Hartford Retirement Planners, and what frustrating time it is to be an investor right now. Just to be completely candid with you, it is difficult. Things that are outside of our control is usually what happens with volatility. But this one seems to be a little bit more self-inflicted. There's policy that's coming out of Washington that's creating a lot of uncertainty, turmoil, and a falling stock market. So let's talk about it and what we do as individuals that are getting ready for or in retirement and we need this money to live off of. How are we supposed to approach this specific situation? I'm going to start with the highest level but most important point that I can make, and that is this too shall pass. We've been through a doozy of things over the last handful of years. We saw COVID in 2020, a global pandemic that no one asked for, but we were all left dealing with them, the uncertainty that came from that. The markets reacted very quickly and sharply. It was one of the fastest declines that I've seen since my time in this career, but also followed by one of the quickest market recoveries I've seen in my career. Took less than a year for a full peak to trough to peak cycle. Then we had 2022 with runaway inflation and interest rates that were going up. Very difficult environment. And we got through that in a little over a year, but under 2 from the time that we were setting new all-time highs, even beyond what we had after COVID. So now we have tariffs, trade policy, and some of the uncertainty that's coming out of Washington. Every time that the market has volatility, it is for a slightly different mix of circumstances. Yet one thing remains true. The markets have always in the past not just fully recovered, but gone on to achieve higher highs. This is the non-financial price we pay, this volatility and this upset feeling we get in our stomach when the market is dropping. If we can see through and have that long-term vision and long-term investment approach, you have always been rewarded for it. Now, I can't guarantee with a 100% certainty because I'm not allowed to for compliance reasons. But if we have a 100% track record of success and recovery the past 150 plus years, I think we should be confident that we know where this thing is headed given enough time. Which brings me to my next point. Joe, when are we going to start seeing some green in the portfolios again? We may already be seeing this by the time that I put the video out. It takes a few days. But we don't know. And as quickly as policy has created the situation, there could be policy changes that could also very quickly move things up. When we were in COVID, it was not uncommon in that time frame to see 5% swings up or down. It's just so volatile. As Dave Ramsey says, you don't want to jump off the roller coaster in the middle of the ride. And right now, the policy, financial markets, we're in a little bit of a roller coaster ride. So if we liked Apple, Home Depot, and these huge publicly traded companies we own in our diversified portfolios, if we liked them a month ago, I think we're going to like them a year from now, 2 years from now, 3 years from now. Better days should be there for us ahead, if the past is any indication of what to expect from the future. So we will be okay. Now, some of you watching this might say, Joe, I'm retired, or I retired over the last couple of months. I don't have forever for a market recovery, even if it takes a couple of years. Probably less, but eventually. What do we do? Well, that's why we don't have all of your portfolio in the stock market. And I know most of the people watching this that are clients of ours probably get their monthly statement and you look at that big number. And is it bigger than the previous month or is it smaller than the previous month? But deeper in that portfolio, in that statement, you're going to see lots of different positions, right? We're diversified. What you will see is not everything is dropping. There are fixed income, there are bonds, there are things outside of U.S. stocks that we own in these portfolios that we can draw from while we wait for markets to recover. In many cases, and I've had a lot of these phone calls and will continue having these phone calls over the next few weeks, it could be 2, 3, 5 years of income needs already set aside in bonds. Let's talk about bonds right now. This market volatility is probably going to force the Fed to lower interest rates. We've been kind of a static interest rate environment. We know that there was a run up during inflation, but economic softness kind of forces the Fed's hand to lower interest rates. How much, how quickly, I'll leave that up for the experts to pontificate. But a lowering interest rate environment is generally good for bonds. And if that's where safe assets are, then they should hold up just fine. At a bare minimum, not be subject to the same volatility as stocks. What we don't want to do is be in a position where you need money to pay your monthly bills in retirement, and we are forced to sell blue chip stocks at temporarily depressed prices. That's why we have diversification, and in many cases, several years of safe money to draw from while we wait for the markets to recover. It's been a proven track record of success. That strategy works. We don't want to be forced to sell things in a down market. I mentioned markets, and I'm going to get a little high level. The market is a place where buyers and sellers transact, right? I'm not telling you anything you don't know. The stock market's no different. For every person selling a share of S&P index or whatever it is, there is a buyer. You cannot sell your shares without someone buying them. And who do we think will fare better over the next, call it 3 years? The person that sold the market or the person that bought it at these prices? If we could go back and buy real estate in 2017, 2018, knowing what the future was, wouldn't we be excited to go back and buy those prices? The stock market does give us those opportunities once in a blue moon. Here it is. So if we do have cash that we don't need for a handful of years, I would strongly consider putting some of that money in the market. And you don't have to do it all at once. If you have $100,000 or even $1 million or something less than that, whatever it is, it's not this on-off switch. You can buy a chunk and then dollar cost average in and kind of see how things play out. You don't have to make an all-in or all-out decision. So if you have cash, strongly consider doing something with it. And if we do have falling interest rates, that doesn't mean that our savings, our CDs, our money markets are probably going to give us much interest in the next few months that are really exciting, like we had in 23 and 24 with rising interest rates. One of the differences between what we're experiencing today and, say, one of the most extreme market volatility events that we've seen in 2008. 2008 was a true fundamental crack in the foundation of the economic system. This is policy-based. So with one stroke of the pen, or maybe a couple of strokes of the pen, this is the situation that we're in. But we didn't have to work through foundational issues now that we did back then. Another stroke of the pen or a policy update can very quickly reverse things and get back to where we were before tariffs dominated the headlines. So that is what makes this so difficult from a timing standpoint, a clarity standpoint, is there's just not much clarity, and we have to wait and be patient. And that's so hard today where we have instant access to news. But one quick policy update, and all of a sudden you could see a lot of green in the markets. Maybe not all the way back to where we were before, but that's what makes this such a fluid situation, and one that is just way too fluid and moving and volatile to try to catch a falling knife as it's going down. You got a 50-50 shot of catching the handle or slicing your hand open. So a 50-50 shot in the extreme volatility, or in the past, 100% success rate of being patient and owning your diversified stock portfolio through multiple investment cycles. So as we wrap things up, clients, if you'd like to review your portfolio and the financial plan, we haven't reached out to you yet, please give us a phone call, send us an email. We welcome those conversations. We want to make sense of this and inject some confidence into your financial plan. If you're not a client and you want to have a second opinion or know what you should be doing with your portfolio at this time, we welcome those conversations as well. And wrapping things up, I just want to make one final, most important point. We will get through this. We will be fine. With enough time stretched out, this will just be another speed bump on our road to prosperity, making memories with families, with friends, all the experiences, the things outside of the stock market. That will continue, and we will be better for it if we can stick to the plan through the temporary volatility. We'll get there. And as always, thank you for watching.